Welcome to the Canadian Investors course, Session 10, Packaged Investment Products. Please read page 2, Terms of Use and Disclaimer. This segment is on packaged products. See the cartoon, page 4? You got the homeless guy saying, actually, I don't care what they do about capital gains. In other words, if you don't have any money, who cares what they do with capital gains? But everybody who's listening to this or watching this probably has money and is trying to figure out what to do with it. So you do care about capital gains. So let's look at managed assets. These consist of mutual funds, segregated funds, ETFs, and wrap accounts, mainly. Mutual funds are a pooling of dollars for many investors. Investors buy units or a dollar amount. The units are bought and sold each business day at 4 p.m. the market close at net asset value, NAV. Money is managed by professional money managers. The prospectus sets out the rules and fee disclosure. The manager invests based on the criteria in the prospectus, and they offer very good liquidity. For all that, the management wants a fee. So the mutual fund fees include management fees, administration fees, trailer fees, deferred sales charges, trading costs, and miscellaneous other fees, all supposedly lumped into the management expense ratio, the MER. So if you want to know what the fee is to operate your mutual fund, ask for the MER. If your advisor does anything but pull it out and tell it to you very clearly, you need a new advisor. And that's when you should be looking for a trusted wealth professional. You can see how to obtain one of those at the end of this session. How do you buy mutual funds? Well, first of all, where do you buy them? You buy them from investment dealers, financial planners, banks, trust companies, discount brokers, etc. And what will it cost? Well, that depends. So, starting with the fees to purchase, you can buy many funds with no load at all. In other words, no front load, no back load, so there's no fee to buy or to sell. You can pay a front load where your advisor says, I'm going to charge you, I don't know, 1% or 5% or whatever it is, usually typically 0 to 5% to buy, and that means that there's no cost to sell. Then there are the DSC funds. There's the short DSC, which is low load, which typically has a hidden 2.5% fee, and you have to hold it for about 3 years. The deferred sales charge, full back-end load funds typically have a 5% upfront fee that's paid to the advisor and a 6-year declining balance for sales. In other words, if you sell it in the first year, it probably costs you 5% to sell it. If you sell it in the last year, it costs you maybe 2 or 3% to sell it. And then the year after that, it costs nothing to sell. Mutual funds almost all pay a trailer fee to the advisor every year, typically 1% on front end, 0.5% on DSC. So if you're going to buy mutual funds, how should you buy them? Well, that depends on what you're thinking. Anyway, let's look at the management style. So for equity, you've got growth managers, sector rotation managers, and value managers. For fixed income, you've got short, midterm, and long-term, interest rate anticipators, and spread traders. Amongst the equity managers, growth managers tend to buy stocks with high price-earnings ratios. They're trying to buy typically value at a GARP, which is growth at a reasonable price. Sector rotators stress market timing. They're trying to own funds, their own stocks in sectors that are doing well, hopefully to outperform the market. Value equity managers try to buy stocks with low price earnings ratios. They're trying to buy stocks that they think are quote unquote cheap. Index mutual funds buy a basket of stocks that match an index. Typically they charge very low management fees because there's not an awful lot of management required, because they're not actively managed, they're passive. and they often beat the returns of active managers. What are segregated funds? Well, segregated funds are basically mutual funds that have an insurance wrapper of some description. Typically, they offer some kind of guarantee, maybe 75% of the original investment guaranteed for the first 10 years. In other words, if you hold the fund for 10 years, they guarantee you that you'll get at least 75% of it back regardless what the market does. If you pass away, many of them have a death benefit of either 75 or 100% of the original purchase price. The MER may be the same or higher than a conventional mutual fund, but if it's the same, it'll probably show the additional cost of the insurance wrapper. So you have to ask about the MERs, because the total MER will be the management expense ratio, including the insurance wrapper. So who sells segregated funds? Well, IROC investment advisors can sell them, and insurance agents sell them. And some MFDA advisors are insurance licensed, and they can sell them too. The bottom line is you have to be insurance licensed to sell a segregated fund. So let's look at one version of these segregated funds, the 4% per year income plus investment. It's basically a variable rate annuity. It offers a 4% guaranteed return after the age of 65. If the income is taken before age 65, the guarantee period is 20 years. So basically what they're doing is they're saying it's really a 20-year variable rate annuity, and because the life expectancy of most people is around 85, if you start to take it before 85, the guarantee period is simply locked at 20 years. So the money goes into segregated funds, and the management fee, MER, the management expense ratio, is a minimum of 3.5%, because there's a more expensive insurance rider on these types of funds than on conventional seg funds. You receive your 4%, which is in fact, but the problem is that the fund also has a buried 3.5% MER. So that means that the fund has to make your 4 plus 3.5 to break even. The extra fee for the guarantee is on the original invested dollars. Inflation could hurt you. The question you have to ask is, can the insurance company continue to pay if things go wrong in the markets? As an investor, don't expect your money back. This is intended to basically return your money to you at a fixed rate over a fixed period of time. And at death, the estate gets the original investment less whatever payouts have occurred. So in other words, if it's paid out for 10 years, expect about half the amount to be paid to the estate. So the bottom line is the big burning question now, after you've learned a little bit about MER, is, does it matter? Well, of course it matters. The higher the MER, the more it takes away from the returns. There are lots of mutual funds to choose from, and your duty is to ask questions. So let's look at ETFs. ETFs are exchange-traded funds. They're bought and sold on the stock exchange. They trade at a discount or a premium to net asset value, the NAV. Most ETFs mimic some form of index. They can be bonds, they can be stocks, whatever. They could be commodities or a portfolio of companies. ETFs originally started in Canada. The very first ones were TIPS and HIPS, which have both converted into XIU, which is basically the TSX I-60 index replicated in an ETF. The nice thing about them is they're very transparent, and they have very low fees in most cases. The index ones have very low fees, significantly lower than mutual funds. And there's always been a controversy about whether one should buy passive ETFs versus professional management. But the passive ETF is going to give you the market minus the cost of running it, which most of the time beats professional managers. Some ETFs are also actively managed. Be wary of those. Ask about the fees, because in some cases the fees for those actively managed ETFs approach the fees charged by mutual funds as the management expense ratio of the mutual fund. Portfolio ETFs exist now too. They're a new generation of ETF. They mimic portfolios. They purport to have fees lower than mutual funds. The fees are hidden, so they're not tax deductible. And some ETFs emulate wrap accounts at lower fees. They're an alternative to mutual funds. And if you start buying these type of things, you have to really ask the question about the management expense ratios, because in some cases they are the same price as mutual funds and perform a similar function, just with a different name. Let's take an ETF example, the iShare S&P TSX Dividend ETF. This is designed to replicate the performance of the S&P Canadian Dividend Aristocrats Index. It has a management fee of 0.6%. It's listed on the TSX under symbol CDZ, and its top holdings were Atlantic Power, AGF, Enbridge Income, IGM Financial, Shaw, Cineplex, Keyera, Thomson Reuters, and Bank of Nova Scotia. Pays a dividend, about 4.26% as of November 2016. It's quite transparent. Now, let's compare the Claymore US Fundamental Index ETF, CLU, to the RBC US Equity Fund. You'll notice that over exactly the same period of time, from January 2009 to November 2009, it was a very good time in the markets. The Claymore Fund generated a 19.25% return. The RBC US Equity Fund generated a 7.25% return. So despite its higher fee, unfortunately, the RBC manager did not outperform the index. Now, let's look at a different one, the Claymore S&P TSX Canadian Dividend Fund, that's CDZ, and compare that to the RBC Canadian Dividend Fund, which is the biggest one in Canada. Well, you'll notice that the Claymore Fund outperformed the RBC Fund by about 1%, which is almost exactly what you'd expect, because the Claymore Fund is approximately 1% cheaper than the RBC Fund. So the difference in performance is the difference in fees. Sorry, that was 9.75 versus 18.25, so about a 0.5% difference, and that's the difference in fees. I stand corrected. In wrap accounts, professionally managed investment plan, all fees are wrapped into a single annual fee. They'll charge anywhere from 1 to 3%. Accounts usually require a minimum size, and the fee is visible, therefore it's tax deductible. That's the fee to the advisor, which is visible. The internal fees of the funds which are purchased in the wrap account are not tax deductible. So what it means is that part of the fee, the part that you can see, is tax deductible. Investors buy in to a specific group of wrapped funds or managed portfolio securities. Investment dollars are allocated amongst asset classes depending on the risk tolerance and the needs of the investor. The choice of allocation, basically, they typically have 6 or more portfolios that you can pick from, and this allocation process can be achieved with mutual funds too. So what's the difference? Well, wrap accounts tend to have slightly lower fees. The management portion of a wrap account, in other words, the visible part of the fee, should be tax deductible. The management fees should be exposed. So in other words, they'll tell you what you're paying for the MERs, the mutual funds, and you'll see the fee that's tax deductible, the fee that the advisor's charging. And most wrap accounts perform rebalancing of the accounts to maintain an asset allocation goal. So that rebalancing can actually enhance performance to a degree. They give investors choice as a manager. Your advisor and you can get together and fire managers or change it up. Some wrap accounts have a manager that monitors the managers. Those ones tend to have a lot of fees because now you're paying them the supervising manager a fee, you're paying the sub-managers fees, and it all gets lumped in, and the total is charged to the client. There is an ongoing debate over performance versus mutual fund, excluding the tax advantages. The allocation method is usually restricted to strategic allocations. In other words, are you 60-40 or 40-30 or whatever you are, and as opposed to a tactical strategy of having increasing or decreasing amounts of different types of investments. And sometimes they're really just a glorified fee-efficient mutual fund account. They're best purchased in no-load format. The advisor receives a portion of the fees. The advisor helps monitor the manager and can initiate switches. And wrap accounts are an alternative to a portfolio mutual fund or a managed mutual fund portfolio. How should an intelligent investor approach wrap accounts? Well, they're really best suited to a hands-off approach to investing. People say, I don't really want to get involved. You take care of it. A wrap account takes care of that. Returns are unlikely to exceed market returns over the long run, but you don't have to have a lot of involvement. And it's a simple approach to long-term investing in a non-registered account because of the tax efficiency. Let's look at unified accounts now. These are sort of one step over from wrap accounts. Are a good alternative for investors who don't want to use the individual stocks in their portfolio and who also prefer not to use mutual funds. Investors visualize individual securities in their account, leading to tax efficiency. They're ideal for passive investors because the unified account can be taken care of by the advisor. They got a little bit lower fees because there's more direct investment and therefore fewer hidden fees. The fee that the advisor charges is tax deductible, and in most cases they provide tactical asset allocation. That is the end of segment 9 on packaged products.